Silver just snapped the market awake. In a matter of weeks, we went from quiet and ignored to how is this even real? A fast run, a sharp drop, and then, like nothing happened, right back toward the highs. That kind of behavior is not normal, and today I'm going to break down exactly what's driving it, why the next few months could get violent, and what most people will miss until it's too late. Because here's the setup. When a market escapes an old reality, it stops moving like it used to. Old rules die fast. The easy indicators start lying, and the people waiting for a comfortable pullback end up watching price leave without them. Before we jump in, quick heads up. I'm running a campaign to eliminate copycats and protect original work on this platform. If you get value from these breakdowns, support me right now. Hit subscribe and drop OG John AG in the comments so I can see who the real ones are. And yes, YouTube stats show most of you watching aren't subscribed. If you want more of this kind of no-fluff analysis, fix that today. Also, because this campaign is live, I opened a WhatsApp channel for the core audience. I'll post daily updates there, share short clips before they go public, and add my personal notes when something important shifts. Link is in the description. Subscribe there too, and you'll stay ahead of the crowd without living on charts all day. One more thing. If you're watching this on a phone, pause and save this video. The next swing will happen fast, and you'll want a reference point handy. Now, here's what we're covering in this video. First, what actually happened in silver and why the recent surge, dip, and snapback matters. Then, the one relationship that can flip silver from steady to feral almost overnight. After that, we'll connect the dots to gold, the bond market, and the policy response that can pour fuel on metals. Then we'll talk miners, why they still look mispriced, and what could trigger a sudden re-rating. Finally, we'll touch oil and the wider commodity complex, because the quiet market is often the one that ambushes everyone. And somewhere in the middle, I'm going to ask you a question that might change how you position for the next 6 months. So stay with me, because the answer is not what the crowd wants to hear. Let's start with the obvious. Silver is acting like it's been released from a cage. The classic pattern for most markets is simple. Run up, cool off for weeks, drift sideways, reset, and then choose a direction. Silver lately? It sprints, slips, and snaps back like a spring-loaded trap. That's why the normal crowd keeps getting baited. They see a fast move and scream top. Then they see a fast pullback and scream collapse. And then silver does the most disrespectful thing possible. It erases the pullback. So what changed? The big idea is this. Silver isn't just a commodity. It's also money. And it's surfing two waves at the same time. One wave is monetary. Confidence, currency stress, the hunger for hard assets, the fear of debt, the fear of policy mistakes, the need for something that can't be printed. The second wave is industrial. Technology, electrification, data centers, solar, electronics, and the reality that demand can grow faster than supply for years before price finally reacts. Most analysts stare at the industrial story only. They talk about panels, chips, and demand charts like that's the whole movie. But when silver flips into a true monetary moment, the character changes. It doesn't crawl higher. It doesn't politely trend. It lunges. Now, there's a specific trigger that tends to spark those lunges, how silver behaves relative to gold. People love the ratio, but I prefer thinking of it as a relationship. What percentage is silver compared to gold? Over long history, that percentage stretches and snaps. When silver is extremely cheap relative to gold, it's like a rubber band pulled too far. It can stay stretched longer than you expect, until it can't. And when it finally breaks through a ceiling, it doesn't tiptoe. It accelerates. We've seen versions of this before. Back in the late 1970s into 1980, silver was already in a bull trend, but then it went wild. Not up a bit. Wild. In a short window, it multiplied. Then, in 2010 into 2011, the same idea. Silver had been rising, frustrating bulls with slow progress, and then it suddenly sprinted and tagged the top of its old long-term range again. Here's the key point. Those explosions didn't start because somebody woke up and decided silver was cool. They started because a ceiling in the silver versus gold relationship cracked. And once it cracked, price behavior changed. Now, apply that idea to today. If silver has been stuck under a multi-year ceiling versus gold, and it finally punches through, you shouldn't expect a calm grind higher. You should expect a new reality. And in a new reality, corrections can shrink from months to days. That's not hype. That's market structure. Think about other markets that lived in long boredom and then snapped. Copper spent decades trapped in an old box. Then it broke out and, in a short time, repriced into a completely different world. Lead did something similar later. Those moves weren't polite. They were compressed, sharp, and shocking. Because when a market spends too long in the wrong place, the catch-up doesn't come as a slow apology. It comes like a slap. So the question is, was silver trapped for too long? For decades, silver kept returning to the same upper boundary. Meanwhile, other assets, metals, commodities, even gold itself, kept establishing new highs over time. Gold's history is a reminder that old highs are not sacred, they are just markers. In prior bull cycles, gold moved multiples from its lows to its peaks. If you study those cycles, you see a pattern. Once a major uptrend takes hold, the move can be bigger than the public expects, and it can last longer than the public's patience. That matters because silver is attached to gold psychologically and structurally. If gold is building into another major phase, silver doesn't need a miracle to go further. It needs permission. And that permission often arrives through that relationship shift. Now, I'm not here to sell you fantasy numbers. I'm here to explain how markets behave when ceilings come off. When the crowd says it's overbought, you need to ask, overbought compared to what reality? Because if the reality changed, the indicator didn't get the memo. This is why the usual technical playbook can become dangerous. People see an oscillator screaming, and they think it guarantees a reversal. But in prior silver explosions, overbought conditions can stick for a long time while price keeps climbing. In other words, the indicator can keep you safe from profit and safe from the move. So how do you handle that without becoming reckless? You separate time horizons. If you're holding physical metal or long-term positions, you don't try to outsmart every swing. You respect volatility, but you don't let it shake you out of a structural shift. If you're trading leverage, options, short-term bets, that's different. Then timing matters. Then a midpoint correction can hurt you even if the bigger trend is right. And yes, even in explosive runs, midpoint corrections can show up. Not the end. A pause. A shake. A moment designed to convince you the story is finished, right before it continues. This brings us to the next important idea: round numbers. Markets love to play games near big, clean levels, not because the universe cares, but because humans do. Round numbers attract attention, orders, fear, and ego. They become battlefields. That's why you can see stalls, fake-outs, and sharp flushes at levels that look obvious. So if silver pushes toward a major psychological milestone, it wouldn't be surprising to see a nasty dip along the way. But here's the trap. People confuse dip with death. They expect the old world to return, and when it doesn't, they're left begging for entry while price is already running again. Here's the question I promised. If silver drops 10 to 15% in a matter of days, would you panic? Or would you see it as the market clearing weak hands before the next leg? Tell me in the comments, honestly. And tell me what you're watching more right now. Silver itself or silver relative to gold? Now let's zoom out to the bigger stage because this isn't only about silver. When the financial system starts wobbling, it doesn't wobble politely. There are quiet areas that can suddenly become loud, and one of those areas is long-term government debt. Most people don't wake up thinking about bond futures. They wake up thinking about tech stocks and headlines. But long-term debt is enormous, and when confidence in that market gets shaky, policymakers tend to respond with more intervention, more liquidity, more support. And whether you call it support or not, it usually means more creation of currency units over time. And what benefits when currency units are diluted? Hard assets. That's why monetary metals can move even when the stock market looks fine. The myth that metals must fall if stocks fall is lazy. Sometimes metals dip with everything during a sudden liquidation event, but history shows they can recover fast and then outperform while risk assets continue to struggle. The correlation is not a law of physics, it's a mood swing. So if you're trying to position for the next phase, don't build your entire plan on the idea that stocks down equals metals down. Instead, watch stress points, debt markets, policy reactions, liquidity moves, and confidence. Now let's talk miners, because this is where things get interesting. Miners are not the metal. They're leveraged businesses tied to the metal. They can underperform for long stretches and then catch up violently when the market finally believes the move is real. And one way to see this is by comparing miners to gold. Over long periods, mining indexes have traded within ranges relative to gold. In some eras, miners held a healthy portion of gold's value. In other eras, especially after major crashes or long bear markets, miners became historically cheap relative to gold, almost like the market priced them as if they were permanently broken. When that relative value hits extreme lows, you often get a setup. If gold remains strong, miners don't need perfection. They need a spark, a shift in sentiment, a wave of capital rotation, a change in earnings optics. And earnings optics matter, even if you hate fundamentals. Because when the metal price rises while production costs don't rise as fast, margins expand. And when margins expand, headlines follow. Then the same people who ignored the sector start buying because the numbers look good. It's backward, but that's how crowds operate. This is why the miners can behave like a second wave trade. Gold moves first, silver catches fire. Then miners, especially silver-leaning miners, can explode as the public scrambles for more torque. But there's a warning. miners are volatile. If you can't handle swings, don't pretend you can. Don't buy miners and then act surprised when they move like a caffeinated animal. That's the deal you sign. So what would I focus on if you're newer and overwhelmed? Start simple. Decide your base. Maybe physical, maybe a broad fund, maybe a small basket. Keep it manageable. Then, if you want more upside, you can layer miners carefully. Not as a lottery ticket, as a calculated add-on. And if you're already experienced, here's a friendly reminder. If you've had wins in this space, share your success in the comments. Even one line. It helps newer viewers stay steady, and it keeps the community real. Now, I promised one more twist. Oil. Oil has been the quiet outcast. While other assets moved, oil spent time feeling heavy. And when a market feels heavy for too long, it can become dangerously interesting. Because cheap doesn't ring a bell until it does. Oil can look depressed relative to other assets, relative to gold, relative to the stock market, and sometimes even relative to its own history. That doesn't mean it must rise tomorrow. It means it becomes a candidate for a surprise move. And surprise moves often happen without a clean headline. Sometimes the narrative says, more supply, weaker demand, it's going lower. And then the market makes one more ugly flush, what traders call a vortex low, where everyone feels confirmed. And then it turns up anyway, because the selling is exhausted. If oil does that, it can change the entire commodity conversation. Because oil is a key input cost across the economy, and it's a huge part of broad commodity indexes. If oil flips, commodities can look less like background noise and more like the trade. That matters because commodities can rally even in messy economic environments. When money is printed and confidence is shaky, real stuff can reprice. It's happened before. It can happen again. And if the commodity complex begins a new leg, you don't want to be the person who only notices after the move is already advanced. Now, quick detour, because I promised I'd do this creatively. If you're also into silver-related success stories, and you want to hear how regular people turn smart positioning into real results, there's a link in the description to a separate channel that focuses on exactly that. Give it a look, and if it helps you, subscribe over there too. Back to the main thread. So where does this leave us? Silver is behaving like a market that has shifted regimes. The relationship to gold is the tell. The speed of recoveries is the tell. The shrinking of corrections from months to days is the tell. And the constant attempts by the crowd to force today's behavior into yesterday's box is the tell. If you treat this like a normal advance, you'll be tempted to sell too early, hesitate too long, and chase too late. If you treat this like a structural shift, you'll respect volatility without letting it bully you. And here's the cliffhanger. If silver is only in the early phase of a new reality, the next big move may not look like a straight line. It may look like chaos, fast spikes, fast drops, fast recoveries. That's how this kind of market tries to shake you. So do this for me. Tell me in the comments which one you think is the bigger driver right now, monetary fear or industrial demand. And second question, if you could only pick one, would you rather own the metal or the miners? And remember, if you're successful, business, investing, career, anything, share one win in the comments. It might be the exact thing someone else needs to hear today. Now, final reminder, support the campaign against copycats. Subscribe and comment OG John AG. Join the WhatsApp channel so you don't miss daily updates. And if you want more of these deep dives with high-stakes implications, hit the like button and share this with one person who keeps ignoring silver like it's a side character. Because if this really is the start of a violent phase, the people who prepared early won't need to chase. They'll just watch the crowd run. And in the next video, I'm going to show you the one signal that would make me cautious even in a bullish setup, so you know exactly what to watch before the headlines catch up.